You said large caps are slow. You said mid caps are smarter. You said small caps give the real returns. And now they're all falling. So tell me honestly, is this a dip or was that confidence misplaced? This is where retail investors get trapped because mid caps and small caps don't fall quietly. And by the end of this video, you will understand whether this is normal volatility or not, or is it a bubble deflation? Why liquidity matters more than fundamentals here, and what signals tell you whether the risk is real or not. Do not skip the middle section. That is where the illusion breaks. Mid caps and small caps rise fast because of lower liquidity, higher growth story, retail participation, and momentum chasing. In bullish environment, liquidity floods the riskier names. Prices expand quickly, valuations stretch faster, retail confidence builds, and that confidence becomes self-reinforcing until the liquidity shifts. That's the part most people ignore. Small caps survive on liquidity. When liquidity is abundant, everything rises. When liquidity tightens, thin stocks fall harder because exits are crowded. When everyone wants to sell, there are not enough buyers. That's why small caps fall sharper than the large caps. Not because businesses collapse overnight, but because liquidity evaporates faster. Liquidity is oxygen. Remove the oxygen, the movement collapses. Bubble doesn't mean fraud. Bubble means expectations are detached from the realistic growth. When price runs ahead of earnings, valuation stretches. The sentiment cools, price reconnects with earnings. Now that reconnection feels violent because correction speed shocks the investors. Now, here is the critical part. Are earnings supporting the price level? If yes, then it is a healthy correction. If no, the valuation compression is there. Now, that's the difference. So, why does this movement so fragile? In the current environment, IT is weak, banks are cautious, rupee is soft, oil is elevated. When macro pressure builds, risk appetite shrinks. Risk appetite shrinkage hits the small caps first because they're perceived riskier. Correlation rises, diversification fails, volatility expands, and confidence cracks. Not instantly, gradually, then suddenly. Here is what the smart investors track: the advanced decline ratio in small cap index, volume on down days, whether rebounds show strength, sector concentration risk. If bounces are weak and selling resumes quickly, risk is building. If higher lows form and participation improves, the correction stabilizes. Don't watch the price alone, watch the behavior. Behavior will reveal the structure. So, should you panic? No. But blind averaging is dangerous. Blind holding is dangerous. Blind selling is dangerous. Structures matter. If the liquidity returns, midcaps rebound violently. If liquidity tightens further, drawdowns deepen. This is a probability game, not emotion game. If you have been overconfident in small caps, that discomfort felt just now, that is awareness. Markets reward the discipline, not excitement. If you want to understand the risk before it explodes, subscribe. Because bubbles don't announce themselves, they whisper through volatility first, and volatility just increases.